News drops. Price explodes upward. You enter fast. Momentum looks strong. Everything confirms the move. Then suddenly, it reverses hard, and the real move starts without you. This keeps happening for a reason. Most Forex traders are taught to react to news, CPI, FOMC, jobs data. Wait for the release. Trade the breakout. Sounds logical. But in today's market, that first move is often the trap, not the opportunity. And if you don't understand why, you'll keep entering right before the reversal. First, the market is already positioned before the news. This is the part most traders miss. Institutions don't wait for the announcement. They position beforehand, based on inflation expectations, rate outlook, bond yields, market consensus. That means when the number finally drops, the market already has exposure. So the first move after news, a lot of the time, it's just the final push of pre-positioning, not fresh direction. Second, the spike is usually liquidity collection. Right after the release, volatility explodes. Why? Because liquidity floods the market. Stop losses, breakout entries, pending orders. Price moves aggressively into those zones first. That's why you see instant breakout, then violent reversal. The market isn't confused. It's clearing orders. And retail traders entering emotionally become part of that liquidity. Third, algorithms react faster than humans. By the time you read the number, the first move already happened. Algorithms process the release in milliseconds, not minutes. So when retail traders finally enter, they're usually entering the exhaustion phase of the spike. That's why the move feels strong, right before it collapses. Here's what it looks like in real time. CPI releases lower than expected. Euro to US dollar instantly spikes upward. Breaks resistance. Everyone sees bullish momentum. You enter the breakout. Then within seconds, momentum stalls. Price reverses sharply, drops below the breakout level. And now breakout buyers are trapped. Why? Because the first spike wasn't the real move. It was liquidity being collected before the actual direction started. Here's the dangerous part. The stronger the first move looks, the more dangerous it can become. Because emotional traders chase strength, but smart positioning usually happens before the release, not after it. So if you're reacting emotionally to the first candle, you're often entering exactly when early positions are exiting. That's why the market feels manipulated after news. Not because price is random, but because most traders are reacting too late. So here's what to take from this. Stop assuming the first move is the real move. Start watching where price was positioned before the release, how far the spike extends, and whether liquidity is being cleared. Because the biggest mistake in Forex right now is confusing volatility for direction. If you've been trapped by the first move after news, comment every time. I want to see how many of you are dealing with this. Next video, I'll break down how to read post-news reversals in real time, before the trap happens. Subscribe if you want the real side of Forex.